A founder's agreement is a contract that spells out who does what, how the company will be run, and how the ownership will be split. Think of it as a prenup for a business partnership. To be enforceable, it must contain the three classic contract elements. Offer: one founder proposes terms, for example, I will contribute the code and get 30% of the stock. Acceptance: the other founders agree to those exact terms, usually by signing the written agreement. Consideration: each party gives something of value: cash, intellectual property, labor, or the promise to work. Additional legal requirements include capacity: founders must be legally competent, adult, not under duress. Legality: the agreement cannot require illegal actions. Definiteness: key terms such as valuation, vesting schedule, dispute resolution mechanism must be clear enough for a court to enforce. Enforceability hinges on writing and signatures under the statute of frauds. Many states require any agreement transferring ownership interest to be in writing. Courts will also look at whether the agreement was entered in good faith and whether any provision is unconscionable, overly one-sided. Many founders include a governing law clause to pick a jurisdiction whose corporate law they prefer, often Delaware. If a dispute arises, the agreement may specify arbitration, which is generally faster and cheaper than litigation. In practice, a well-drafted founder's agreement can survive the churn of early-stage startups, while a vague or oral agreement often leads to costly lawsuits that distract founders from building the business. Equity is the ownership slice of a company, and there are two main classes of shares that matter to founders. Common shares: these are the default shares that most founders receive. They carry voting rights, usually one vote per share, and the right to receive any residual value after the company is sold, but they sit behind preferred shares in a liquidation. Preferred shares usually issued to investors in a financing round. Preferred shares often have liquidation preference. For example, 1x means the investor gets back the amount they invested before anyone else gets paid. Dividends: sometimes cumulative, sometimes not. Anti-dilution protection: price-based protection that adjusts the conversion price if the company later sells stock at a lower price. Conversion rights: preferred can be converted into common, often 1-to-1, to allow investors to share in upside. Founder allocation: at the outset, founders typically receive a pool of common shares. Example: a startup authorizes 10 million shares. The founders might allocate 6 million to themselves, 60%, set aside 2 million for an employee stock option pool, 20%, and reserve 2 million for future investors, 20%. The split matters because any future preferred share issuance will dilute the common share percentage. If investors demand 20% ownership after a Series A, the founder's share will shrink accordingly. The key is to model the post-money cap table so founders understand how much of the pie they will keep after each financing round. Real-world analogy: think of a pizza cut into slices. Common shares are like the crust that everyone can eat. Preferred shares are a special topping that is served first to certain diners. Even though the crust is still there, the portion of the pizza each person gets shrinks as more toppings, investor shares, are added. Vesting is the method by which founders earn their equity over time or upon achieving milestones. It prevents a founder who walks away early from keeping a large portion of the company. One-time-based vesting: the most common schedule is 4-year vest with a 1-year cliff. Cliff: no shares vest until the first anniversary, then 25% vests at once. Monthly or quarterly thereafter. The remaining 75% vests evenly over the next 36 months or quarters. Mathematically, if a founder has 1,200,000 shares, after 1 year they own 300,000 shares, 25%. Each month thereafter they earn 25,000 shares, 1,200,000 divided by 48 months. 2. Milestone-based vesting: shares vest when a specific event occurs, such as completion of a prototype, securing a key partnership, reaching $1 million in annual recurring revenue. For example, a chief technology officer might receive 500,000 shares that vest 50% when a beta product launches, and the remaining 50% when the product hits $500,000 in annual recurring revenue. 3. Hybrid schedules combine time and milestones. Example, 50% of shares vest over 4 years, time-based, and the other 50% vest when the company hits its series of valuation target. Why vest? Imagine the company as a garden. Time-based vesting is like watering the plant steadily. Milestone-based vesting is like adding fertilizer only when the plant reaches a certain height. Both ensure the garden company continues to grow before you reap the fruit, ownership. Acceleration clauses speed up the vesting of unvested shares when a triggering event occurs, most commonly a change of control, sale, or merger. Single trigger acceleration. Upon the sale of the company, all unvested shares immediately become vested. This is simple but can be problematic for buyers because founders walk away fully vested, potentially reducing the incentive to stay and help with integration. Double trigger acceleration. 2 events must happen. Trigger 1, change of control, sale, or merger. Trigger 2, the founder is terminated without cause or leaves for good reason within a set period, often 12 to 24 months after the sale. Only when both occur do the remaining shares vest. This protects founders if the new owner dismisses them while still keeping them incentivized to stay post-sale. Legal implications. Acceleration clauses must be clearly written in the founder's agreement or stock purchase agreement. They are enforceable under contract law, but some jurisdictions view overly broad acceleration as a breach of fiduciary duty if it unfairly dilutes other shareholders. Investors often negotiate limits. For example, only 25% of unvested shares may accelerate to protect their dilution. Example, a startup sells for $100 million. Founder A has 1 million shares, 40% unvested. With a double trigger clause, if the acquirer keeps Founder A for 12 months, the shares continue to vest normally. If Founder A is fired without cause after 6 months, the remaining 400,000 shares vest immediately, giving Founder A the full ownership that he would have earned over the next years. Think of acceleration as a fast-forward button on a video. Single trigger presses the button automatically when the movie ends. Double trigger only works if someone also hits the pause button, termination, right after the end. When a company raises new money, the percentage of the company each shareholder owns usually shrinks. This is called dilution. Pro rata rights, also known as preemptive rights, give existing shareholders the option to buy enough new shares to keep their ownership percentage unchanged. Basic dilution formula. Let S old equals total shares outstanding before financing. S new equals new shares issued in the financing. S post equals S old plus S new equals total shares after financing. P old equals shares founder divided by S old equals founder's pre-money ownership. P post equals shares founder divided by S post equals founder's post-money ownership. Example, founder owns 3 million of 10 million shares, which is 30%. The company issues 2 million new shares to investors. S post equals 12 million. Founder's new ownership equals 3 million divided by 12 million equals 25%. So the founder is diluted from 30% to 25%, a 5 percentage point dilution. Pro rata right calculations. Shares to purchase equals P old times S new equals 0.3 times 2 million equals 600,000. If the founder purchases 600,000 shares, his post-money ownership becomes 3 million plus 600,000 divided by 12 million equals 30%. Thus, the right protects the founder's slice of the pie. Real-world analogy, imagine a group of friends sharing a pizza. If more friends join and order extra pizza slices, each original friend gets a smaller slice unless they order extra slices for themselves, which is like pro rata. The math ensures everyone can keep the same percentage of pizza they started with. Investors often negotiate a pro rata participation clause that specifies how much of the new round each investor can buy. For example, up to 100% of their current ownership. Failure to exercise the right can result in permanent dilution. Founder departures are governed by the founder's agreement and often include 3 categories of termination events. Voluntary resignation. Founder quits on their own. Usually unvested shares are forfeited and vested shares remain, but may be subject to a buyback right at fair market value. Termination for cause. Founder is fired for misconduct, for example, breach of fiduciary duty. Most agreements allow the company to repurchase all vested shares at a pre-agreed price, and all unvested shares are automatically forfeited. Termination without cause or good reason. Founder is let go without fault or leaves because the company materially changes terms. Often the agreement provides a payoff where a portion of unvested shares vest immediately, sometimes via a double trigger acceleration. Repurchase rights. The company may have a right to buy back vested shares at a predetermined price, often the lower of fair market value or original purchase price. The formula can be buyback price equals the minimum of fair market value at termination and original exercise price. If a founder's vested shares are worth $2 each on the market, but they originally bought them for 10 cents, the company may repurchase at 10 cents to protect other shareholders. Forfeiture calculation example. Founder A has 1,200,000 total shares, 800,000 vested, 400,000 unvested. Founder resigns voluntarily. 400,000 unvested shares are forfeited, returned to the option pool. 800,000 vested shares stay with the founder unless a repurchase right is triggered. If the agreement gives the company a right to repurchase at 20 cents per share, the company can pay $160,000, 800,000 times $0.2 to buy back those shares. Analogy: think of a lease on an apartment. The lease founder's agreement says you own the furniture shares only after you have lived there for a certain time, vesting. If you move out early, voluntary resignation, you leave the unfurnished furniture behind, forfeiture. If you break the lease cause, the landlord can take back all furniture, even the pieces you already owned, repurchase. Explanation: equity that vests is considered compensation for tax purposes. The Internal Revenue Code Section 83B election lets a founder elect to be taxed on the fair market value of the shares at the time of grant, rather than when they vest. Without Section 83B election, taxable income is recognized each time a portion vests. Example: a founder receives 1 million shares that vest over 4 years. If fair market value at year 1 vest is $0.10, they owe tax on $100,000, 1 million times 0.1 times 25%. If fair market value later rises to $5, the tax at year 4 would be $1,250,000. This can create a huge cash flow burden. With Section 83B election, the founder files a written election with the IRS within 30 days of the grant. They pay tax on the fair market value at grant date, often nominal, for example $0.01 per share. Using the same numbers, FMV at grant equals $0.01, taxable income equals $10,000, 1 million times $0.01. No additional regular income tax when the shares vest later, though any later appreciation is taxed as capital gains when the shares are sold. Risks: if the company fails or the shares become worthless, the founder cannot recover the tax paid on the Section 83B election. Therefore, founders typically file the election only when they are reasonably confident the company will have value. Mathematical example: let n equals total shares granted equals 1 million. V sub g equals fair market value at grant equals $0.01. V sub v equals fair market value at vesting year 4 equals $5. T equals ordinary income tax rate equals 35%. C equals long-term capital gains rate equals 20%. Without Section 83B, tax each year equals n times v sub year times 1/4 times t, assuming linear growth. Total ordinary tax approximately $1.75 million. With Section 83B, immediate tax equals n times v sub g times t equals 1 million times 0.01 times 0.35 equals $3,500. Later, sale tax equals open parenthesis v sub v minus v sub g close parenthesis times n times c equals open parenthesis 5 minus 0.01 close parenthesis times 1 million times 0.2 approximately $998,000. The election saves the founder roughly $750,000 in ordinary income tax, shifting most tax to the lower capital gains rate. Practical tip: file the Section 83B election with a copy to the IRS, the company, and keep a signed receipt. Missing the 30-day deadline invalidates the election. Analogy: think of a mortgage with a low introductory rate, grant fair market value. Paying the interest early, Section 83B tax locks in a low cost, even if the market rate, future fair market value, spikes later. If the house never appreciates, you have overpaid interest, but most buyers hope the property value will rise. Question 1, multiple choice. A startup's founders sign a founders agreement that includes a 4-year vesting schedule with a 1-year cliff and a double trigger acceleration clause. 6 months after the company is acquired, the acquiring firm terminates founder B without cause. Which of the following statements is correct? A. All of founder B's unvested shares immediately vest. B. Only the shares that have already vested remain vested. Unvested shares are forfeited. C. Founder B's unvested shares vest only if the termination occurs after the change of control. D. No shares vest because the cliff has not been reached. Model answer 1. The correct answer is D. The 1-year cliff means no shares vest until the first anniversary of the grant. At 6 months, even though a change of control has occurred, the double trigger requires both a change of control and a termination after the cliff. Since the cliff has not been satisfied, all shares remain unvested and are forfeited upon termination. Question 2, short answer. Founder C holds 2 million common shares out of 10 million total outstanding shares, 20%. The company raises a Series A round by issuing 2.5 million preferred shares to investors. Calculate Founder C's ownership percentage after the round and the number of additional shares Founder C must purchase to maintain his 20% ownership, assuming he has pro rata rights. Model answer 2. Post-money total shares equals 10 million plus 2.5 million equals 12.5 million. Founder C's new ownership equals 2 million divided by 12.5 million equals 16%, a dilution of 4 percentage points. To keep 20%, required shares equals 20% times 12.5 million equals 2.5 million. Additional shares to purchase equals 2.5 million minus 2 million equals 500,000 shares. Question 3, essay 300 words maximum. Explain the tax consequences of filing an IRC 83B election for a founder who receives 500,000 shares at a grant date fair market value of $0.02, which vest over 4 years. Assume the ordinary income tax rate is 35% and the long-term capital gains rate is 20%. The fair market value at the end of year 4 is $4. Include a discussion of the risks of the election. Model answer 3. When the founder files a Section 83B election within 30 days of the grant, he elects to recognize ordinary income on the entire 500,000 shares at the grant date fair market value of $0.02. The taxable amount is 500,000 times $0.02 equals $10,000, resulting in ordinary income tax of $10,000 times 35% equals $3,500 paid immediately. No additional ordinary income tax is due as the shares vest. When the founder later sells the shares after 4 years at $4 each, the gain subject to capital gains tax is $4 minus $0.02 times 500,000 equals $1,990,000. At a 20% long-term capital gains rate, tax owed is $398,000. Without the Section 83B election, the founder would have been taxed on the fair market value each year as the shares vest. Assuming linear growth, the average annual fair market value would be roughly $2.01, leading to ordinary income tax of about $350,000 over the 4 years, far higher than the $3,500 paid up front. Risks: if the company fails and the shares become worthless, the founder cannot recover the $3,500 paid. Also, if the grant date fair market value is understated, for example due to a low 409 evaluation, the IRS may later recharacterize the election, causing penalties. Therefore, founders should only file Section 83B when they are reasonably confident of future value, and when the grant date fair market value is accurately documented.